How do I diversify a portfolio? Where is a stock it's going to go? Two questions that investors often ask. I'm Tom Preston, Chief Market Strategist for tastylive, and I'm going to talk about both those concepts. So in this week's Cherry Picks, Mike Reckentine and Nick Batista show some interesting visuals here. The first one is the expected move versus the actual move. And that's going to talk about the idea of where a stock might go. Again, nobody knows. There's no real way to predict it. Some of these numbers might give you a clue. What they showed is a graph of, this is the SPY, the S&P 500 ETF, 2022 to July 2024, or the end of June 2024. Back here where this green cone starts is the end of 2023. What this cone is the one standard deviation range projected by the SPY's implied volatility at the end of 2023 that shows you 68% of the time the volatility predicted that the SPY would land in this range in the future. Guess what? It didn't. SPY has had a massive rally, particularly in the first quarter, and then it sold off a little bit, and now it's way beyond what that expected range was. Why did that happen? Well, whatever the reason why, it doesn't really matter. The fact is that it did, and that illustrates 2 points. First of all, if you were betting that the SPY wouldn't do that it was going to sell off, having a defined risk trade would have limited your potential losses if you were bearish on the SPY. The second point is the probabilities aren't necessarily wrong, but that if you do enough trades, if you look at enough symbols, yes, like anything else, you will see outliers. And in this case, the SPY is a definite outlier. This blue point here represents probably close to a 3 standard deviation move in the SPY based on the end of 2023's implied volatility. This particular tool, it's just a tool. Let's take a look at how you can find it yourself. Let's go to the platform. SPY is already loaded up here. And let's go to the chart. And I'm going to go into indicators. Let's show you the indicators. And I'm going to scroll down to probability of expiring. I have that on there. I double click and add it. And here are these lines. Okay, and you can edit these to your heart's content. For the sake of just illustrating this, these are numbers that I created, the probability numbers I created years ago in graphical form. This green line represents a 1 standard deviation range. In other words, there's a 68% chance that the SPY is going to land inside this range by, that date is the end of July. The dates down at the bottom, you see the dates down here. As of July 19th, there's a 68% chance it's going to be in this green range, 95% probability that it's going to be in this blue range, 99% probability is going to be in this red range. That's what that tool is. And I think it's fairly helpful. Again, it doesn't tell the direction a stock's going to go, but it shows you what the market thinks the potential magnitude of the price change is going to be. As we go back to the cherry picks, now here are 6 ETFs the guys are talking about that are expecting a larger potential move. Basically, what they sorted out is they went through the ETFs, the most popular liquidly traded ETFs, found the ones with the highest implied volatilities, which translates into potential higher expected moves. Okay. EWW, the Mexico ETF, SMH, the semiconductors, SLV, silver, gold, EWZ, the Brazil and KRE, the banking, regional banks, they all display levels of high implied volatility and IV rank. It means the market, quote unquote, all the traders are expecting a large movement in them over the next month, and they're also on the higher end of that range compared to the way they have been historically. EWW, SMH, EWZ, KRE, FXI is actually kind of high too. The important thing about this is that when a symbol, a stock or an ETF or an index or even a future, if its options have higher implied volatilities, it means that you are being rewarded for taking risk. It doesn't mean you're going to have a winning trade. It just means that you're being rewarded for taking a risk. So if you're a premium seller and you think that the stock or ETF isn't going to move as much as the market thinks it might, well, you're selling premium, selling calls if you're bearish, selling puts if you're bullish, or selling strangles if you're neutral. Those are trades that take advantage of the higher implied volatility. So we might take a look at a couple of these symbols here. The next step is talking about correlation. These 96 symbols have a near perfect correlation to the SPY. The S&P 500 is obviously calculated from the 500 stocks that are its components, but it also impacts them. In other words, when an index fund or a pension fund or an insurance company has to match the S&P 500 performance, they'll just start buying all those component stocks. In a sense, the S&P 500 drives the price behavior of those underlying stocks. I know that's kind of backwards way of thinking about it, but in practice, that can be what happens. That's why a lot of the stocks that people trade have very high correlations to the S&P 500. Traditionally, an financial advisor might say, well, diversify in consumer non-durables and energy stocks and biotechs and that sort of thing, and think they're diversified that way. But the reality is most, especially US equities, move up and down at the same time. They don't offer much diversification because their correlations with the S&P 500 are so high. Let's go down and take a look at a couple of symbols that do not have very high correlations with the SPY and the American market. Here, the guys point out the South Korea EWY has 67, EEM, emerging markets 65, Taiwan 62, Japan 56. A high correlation is, let's say, above 80, in my opinion. That's kind of my benchmark. Yours could be higher or lower. You want something, if you're looking for diversification, something in the lower end, let's say 40% correlation is the EWZ, the Brazilian ETF, and FXI with China with 39% correlation. If you are looking to diversify a portfolio, a US equity portfolio, EWZ and FXI are ways to do that. The other point is, right now, the SPY volatility is painfully low. So if you look at this and look at SPY right now, the volatility, the overall volatility going out to July expiration is 13%. Brutally low. The VIX right now is only 13.13. Compare that to EWZ, which has a 45% IV rank, and the July options have 26% volatility, so twice as much. Let's take a look at FXI. FXI has a 19% IV rank, not very high, but again, it's actual applied volatility, the 27%, 30% range, which are over twice what the VIX is. So there are two ways you're diversifying with these symbols. You're diversifying both from a correlation standpoint and through a volatility standpoint. That is a different, new way to think about diversification. Let's go and look at a couple of potential trades. I think the guys talked about NVIDIA a lot. Of course, it's very popular, but I think let's talk a little bit about maybe potential trades in EWZ and FXI. EWZ, I know, has been crushed lately. EWZ, for whatever reason, has been going down. Just for the sake of argument, let's pop in that probability cone and see where it might go. There's a 68% chance by the July expiration it's going to be down to about 50, just under 26, around 26.75. Two standard deviations, around 24. It's sold off a lot. Maybe I'd consider a bullish trade in EWZ, maybe, if I were looking to get long. And if I were, I'd go out to, let's say, the August, let's take a look at the Julys for the sake of argument. Again, looking at these, there's not a lot of premium in here. If I sold the 26 put, I would have a max profit of 22, max loss 25.78 versus buying power $400. That's a little low. Let's kick this out to 42 days. And now I'm getting a little bit more reasonable numbers. Now my profit is up to 33. I have a 92% probability of capturing half of that. My theta is up to 0.85 cents a day, which is a decent theta return on capital versus $407 of buying power. Max loss again, 25.67 if EWZ goes to zero. But if I were either bullish on EWZ after it's sold off so much, or I just wanted some diversification against the S&P 500, selling a put in EWZ might be a possibility. Let's take a look at FXI. FXI, China ETF, has been in a relatively tight range recently. Yeah, it had a good rally through the spring, late spring into the middle of spring. Here's middle of April, here's the middle of May. Big rally here, but then is sold off. So it really hasn't moved very much. And again, looking at some of these probability cones, maybe a neutral trade in here. Maybe if I thought the 2 standard deviation range about 23 on the downside and about 29 or 30 on the upside for 2 standard deviations. Well, let's just go take a look at the options, see what they said. So I'm going to go up to the AUG weeklies, 42 days. Those premiums aren't high enough. Let's look at the 1 standard deviation, 28 versus about 24.75, 24.25. 28 or the 28 half. A neutral trade here, if I thought FXI was going to trade in a range for the next few weeks, these aren't bad numbers. I have an 89, I collect a max profit of $47. Max loss is infinite, but that's if FXI goes to infinitely high. A more realistic number maybe is the buying power effect, which is $382. I collect, I don't know, about 10-12% of max profit if I get the max profit, about 6% if I take it off at 50% profit. I generate $1.40 of theta per day versus that buying power effect. That gives me a decent theta return on capital. These are 2 trades. The EWZ trade and FXI are 2 ways for an investor to think about symbols that have low correlations to the rest of their portfolio, specifically to the SPY. The other thing they do is take advantage of their relatively high implied volatility. And the third thing, going back to that expected move, yeah, it's an indicator. It is not guaranteed, but it can give you a little bit of guidance about what the market thinks a stock might do versus what your analysis comes up with. If you want to get these cherry picks delivered to your inbox every week and my cherry bombs with trade ideas every day, click on the link below.